Literally, I'm upset with Alibaba today. We want lower prices. They're cutting costs. That difference is very little.
Very, very little.
Companies like this have a hard time going under. The googly moogly. Google stock is like the rest of the NASDAQ. It is rip-roaring to go right now. Let's check the chart in the last 1 month. It's up 17% to $103. Its 52-week low was just back on November 3rd at $83. If you remember, November 4th was Meta's all-time low. Not all-time. Meta's one-year low of $88. So both these companies had their low around then. Now, Google, they're cutting costs. They're still printing money. In fact, I think Charlie Munger doesn't Charlie Munger say, Mo, that he thinks Google has the strongest moat like ever?
Yeah, I've heard him say that before.
But now Google's being sued by the Department of Justice, and I'm hoping that drives the share prices down a lot.
Yeah.
That's what we want to do. You might hear that and go, wait, what? If you're new to the channel, we are true value investors. We're not people out there who say they're value investors and then run away when things are scared. We want lower prices. Literally, I'm upset with Alibaba today because it just now started going down. I needed to go down 2 weeks ago. So either way, these are the things we talk about. So that's new, but interesting. Subscribe to the channel. And also, if you want to hear me talk more on a day-to-day basis about investing, follow me on Twitter at Paul Gabriel. It's going to pop up right here. Follow me there. I do a lot of interaction with people, and I talk a lot about investing and my views on the market. So, Mo, what do you think about the Goog?
Well, I think they're incredible. And it's made me, the last couple of weeks I've been thinking a lot because of this chat GPT thing is coming out. And now Google's saying they're going to come out with their own chat GPT. It's just not ready and they're taking their time. And in my mind, I go, yeah, Google's going to crush chat GPT over a long period of time. They already have, when I say, Paul, go search for something on the internet.
There's no question what I'm doing.
You're not going to Yahoo or Bing or Chat GPT. You're going to Google. It's everywhere. I just got an email right now. Google popped up on my phone. I don't even use it. I just use it because it alerts me so much faster than Apple. It's amazing.
The two largest search engines in the world are Google and YouTube. You're on YouTube right now watching us. Who owns YouTube?
Google.
Yes. Google bought YouTube for $1.65 billion in 2006 or 7. I think it does that per month in revenue now. Or something crazy like that.
And if you think that Google isn't going to crush any competitor that comes in there.
Listen, I won't say that, Mo.
I think they're going to do a really good job of
technology is very, listen,
True.
But I do think Google has this big hold on the world. I mean, look at you. You don't use Android.
Or they'll go buy them.
Yeah, probably. So here are the things I like about Google. Market cap. If you bought up all the shares.
Yeah.
Enterprise value. You bought the entire company with no debt. That difference is very little.
Very, very little.
$80 billion. Sounds like a lot of money, but relatively as a percentage, it's very low. Now, another thing, high return on invested capital. The 5-year return on invested capital is 14.5%. This means that Google gets a high return on the money that's invested in the business, which means if they want to grow revenue and profit, they don't have to invest as much money as other companies who might have a 8% return on invested capital. So you want to find companies. That is the kind of moat that kind of shows the moat. Yeah. Warren Buffett and Charlie Munger and all value investors I know of love a high return on invested capital. But just because it has a high return on invested capital doesn't mean you buy it at any price. Right. You still need to pay a cheap price. Right. The 5-year PE is currently 28.
A little rich.
A little rich.
Actually, maybe.
Yes, we don't know.
Yeah.
But, and by the way, I'm actually surprised by this gross profit margin. I thought it would have been higher.
I thought it would be
55%.
Yeah, I thought it would be higher.
But either way, I think a big reason to that is they have to share so much in ads and all that stuff. But a bottom line profit margin that's solid. Let's go check out, and no dividends. Let's go check out the 8 pillars.
Wait till you see this debt number.
Now, guys, on our software, which you'll learn more about shortly, you can do your own pillars based on your own metrics that you like. These are the pillars that I use. But here are the things. The 2 X's are the 5-year PE and 5-year price of free cash flow. Now, does that mean the company's expensive? Well, I don't know. Because if a company's going to grow 100% per year, would I pay 30 times earnings and free cash flow to own it?
Yep.
Absolutely. What were you going to say I was going to like?
The debt number.
Guys, look at this. 0.89. This is the long-term liabilities divided by their 5-year free cash flow. This says that the company can pay off all of its long-term liabilities with 0.9 years basically of their free cash flow.
10 months, 10 and a half months.
10 and a half months, 10.8 months of their free cash flow.
That's amazing.
Companies like this have a hard time going under.
Yes.
When there's so much cash on hand that they can pay off all their debt very quickly, it's hard to go under.
And companies like this can afford to go do things and try them and not worry about getting in any trouble.
Yeah, they call it their other bets.
Exactly.
Guys, I can already tell you, I love Google. It's just a matter of what's the right price to pay for it. So let's see what analysts are saying about Google. Now, guys, remember about analysts. There's a bias there. So I take these with a grain of salt. However, I know people like them. People like to look at their analyst estimates. Google's expected to make, according to analysts, 52 analysts out there that we get, $5.39 per share this year. And by December 2027, they're going to make almost $10. So it's almost doubling, which is real solid. Definite double-digit growth in earnings per share. Awesome. What about revenue? They're expected to do 315 this year, go to 470, basically 10% growth every year. Not bad. For a company that large, that's pretty solid.
Yeah. Pretty good.
But the question becomes, even though it's growing, you can still overpay. Look at Intel, Cisco, Micron. They're not at the prices they were 22 years ago, 23 years ago during the dot-com bubble, even though those were the Googles and the Apples of those back then. If you overpay, it'll hurt you. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. So what is the appropriate price to pay for Google? Well, as you know, our stock analyzer tool used over 1.3 million times last year. This does not include the balance sheet, which is already very good with Google, but Mo and I are going to run the numbers on this. He's going to do a 10-year analysis. I'm going to do 20. Yep. Now, if you like the software and you're interested in these other tools that we haven't even talked about or done here, and you've seen our videos before, and to get the community, we're running a great special right now. $7 for 7 days. Try out the software. If you don't like it, you cancel. You're all good for those 7 days. But it's a good way to get in at $1 a day to try software that I can assure you, if used properly, it'll be the best investment you can make literally today. So let's do our analysis. I'm going to do 20 years. I'm going to talk a little out loud while Mo does his. Since I'm doing a 20-year analysis, the question becomes, can they sustain? They did 20% growth over the last 10 years per year. There's no way that can continue for 20 years. Just to let you know that, 1.2 to the power of 20, that would be 38 times more revenue 20 years from now than today. They're doing currently $282 billion in revenue in the last 12 months. That would take them to $11 trillion in revenue. The entire US economy today is $25.6 or $26 trillion. No, not going to happen. So let's go do our assumptions here. Let's see here. 4, 7, and 10. Profit margin. Okay, free cash flow margin. Okay, PE. And I think Mo's already done.
I am finished, yep.
So, Mo, Why don't you tell me your revenue growth and I'll tell you mine.
Okay, so I did 5, 7, and 9. Now, the reason I did 5 is I came over the income statement, and the last couple of years have been pretty big growth outside of their path. So that's where I tamed that number a little bit.
Okay.
So that was my reasoning for that. I know 5 looks low.
Okay, I did 4, 7, and 10.
Okay, but you're doing 20 years.
I'm doing 20 years. I don't think 4... I think 4 is very reasonable. Yeah. So 4% revenue growth for the next 20 years would take them to $620 billion. I
actually think it's very reasonable.
I think that's very low.
Yeah.
Okay, profit margin.
19, 22, and 25.
I did 20, 22, and 24. Okay. Guys, they haven't done 19 or 20 at all. We're just trying to be conservative here, but also go, okay, what if they sustain this but go higher?
25 is high.
25 is high.
Yeah, so...
Free cash flow?
19, 22, and 25 just because they're so similar.
I matched mine as well. 20, 22, 24. PE?
15, 16 and a half, and 18.
Same with me.
Okay.
The reason being, high return on invested capital. Yep. I'm cool with that. Yep. Finally, desired return.
11, 12, and 13.
I did my typical now, 10, 12, and 14.
Okay.
Now, this is a question I'm getting a lot in the community. Paul, why are you doing 10%? Isn't that what you think the company's worth? It is. But I already beat up the company here.
Right.
The higher, basically I look at 10% as what's the value of the business. Because I can get 10% by investing in a long-term ETF. But if I've already beaten it up like crazy here, I don't need to beat it up as much down here. Mm-hmm. And the more aggressive I get, the higher desired return I need because it's less likely to happen.
All right.
So I need a bigger return. All right, hit your analyze button. Now, before we do that, actually, let's look at the chart real quick.
Okay, let's do that. Let's see what Google has done.
Now, guys, something we do different than other value investors is other value investors will say, listen, if a stock is cheap, you buy it. If it goes cheaper, awesome. And I get that. But we're now in a current situation where the market has skyrocketed, especially these high-flying big stocks. And I think to myself, if I believe the market's overvalued, any sell-off will absolutely sell off these large companies.
And you wouldn't expect to see this on Google, one of these situations, right?
Right.
I mean, that to me is very surprising in and of itself. Just shows any stock can fall like this. But the big thing for me right now is this. I showed it in the Apple video that we did, this upward trajectory. Right when you get prices that just spike up, they are going to come back down. That's just how it works. So right now, you're seeing that with Google. It's going to come back down.
And look at this. I look at the money flow index. It's currently at 68. Guys, whenever this is high before, what happened after?
Yep.
This high before, what happened after? This high before, what happened after?
Exactly.
this high before. What happened after? I look at this as saying, I get it. I trust me. I'm a value investor, but I also want to do the things that make sense to me. And when we see a massive run up like this, I got to pay attention to that.
Those are some pretty strong correlations, right? You're only going back to the beginning of 2022. It's happened 4 times, but it happened every single time.
Yeah. So to me, the money flow index means so much money is flowing into this business. At some point, I got to be like, hey, wait a second. This is going to pump away. And what's going to happen to the stock when that happens? Is that timing? Maybe. I don't think it is because I'm using data to determine that. But I look at this saying, hey, if I can be patient, just wait a little bit longer. If the stock is, that's assuming the stock is still valuable at the price today.
Yeah.
So let's go see what those values are.
See what it's worth.
Mo, what'd you get?
Okay, I got $66 on the low end, $113 on the high end, and middle ground about $88.
Look at me.
Watch list for 95.
72 on the low end, 120 in the high end, 93 in the middle. And let's go see what that determines. Let's go change all of our values to 10%. It does 72 on the low end, 120 in the middle, 200 on the high end. So if God came down tomorrow and said, Paul, your high end number is going to happen, even your middle number, I'm buying the stock all day long today because I'm going to get a great return. Yep. That's where we stand, guys. So again, $7 for 7 days, and please subscribe to the channel. Thank you very much for your time.